This is an Uncovered Japan Company research report on PHYZ Holdings, ticker 9325. PHYZ is a Japanese third-party logistics company that runs warehouse operations, transport, and delivery for e-commerce customers. The opportunity is a direct link to Japan's online commerce growth. The central question is whether the company can turn its new logistics capacity into profitable growth while reducing its dependence on one very large customer. At the report reference date, PHYZ traded at 8.8 times forward earnings, 12 times trailing earnings, and 2.65 times book value. Fiscal 2026 return on equity was 23.9%, while the dividend yield was 3.31%. The low forward multiple is eye-catching, but it depends on management delivering a strong profit forecast. The equally important number is customer concentration. Amazon Japan accounted for 69.1% of consolidated sales. PHYZ is best understood as outsourced physical operations for online retail. It receives goods, stores them, picks and processes orders, packs parcels, moves them through trunk and route transport, and supports last-mile delivery. The group also runs a freight matching platform to improve truck utilization. This is a labor-intensive model, not a software business. PHYZ began as the logistics arm of a staffing company, which makes recruiting and retaining warehouse workers a practical advantage in Japan's tight labor market. PHYZ has delivered rapid top-line growth. Revenue rose from 18.0 billion yen in fiscal 2022 to 40.3 billion yen in fiscal 2026, a 2.2 times increase and roughly a 22% annual compound rate. Operating profit also rose over the period, reaching 1.53 billion yen. But the latest year is the key nuance. Operating profit grew just 4.6%, and the group operating margin slipped to 3.8% as warehouse startup costs and higher wages weighed on the model. The segment mix shows where the investment story will be decided. Operations is 67% of sales and the company's main engine, yet its fiscal 2026 margin was only 3.49% after falling from 5.11% a year earlier. Transport is 26% of sales, with a 4.42% margin, and its profit rose 47% as price negotiations and utilization improved. Information systems is small, but highest margin. The core test is whether the much larger operations segment can recover productivity and pricing. This chart contains the thesis in one number. Amazon Japan made up 69.1% of PHYZ's fiscal 2026 sales, and Amazon-related revenue grew 31.5%. That makes PHYZ a rare listed way to gain exposure to the growth of Amazon's Japanese fulfillment activity. It also gives a single customer enormous influence over volumes, pricing, and contract terms. Management is explicitly trying to diversify toward other major e-commerce and distribution customers, but the concentration has risen rather than fallen. PHYZ's advantages are operational rather than technological. Its staffing heritage helps it source and train labor, the binding constraint in Japanese logistics. Its one-stop bundle links warehouse work, transport, last-mile delivery, and freight matching, creating convenience and switching costs for clients. The AZCom Maruwa parent provides credit and a wider logistics platform. Those are genuine strengths, though none is an impregnable moat. The same parent owns 58.27%, which also creates minority governance and take-private risk. The cash flow profile reflects an investment phase. Fiscal 2026 operating cash flow was 1.65 billion yen, but free cash flow was only 220 million yen as PHYZ invested in new capacity. In the report's base forecast, free cash flow turns negative in fiscal 2027, before recovering as the warehouse ramp matures. The balance sheet is therefore an important watchpoint. The issue is not whether PHYZ can grow revenue, it is whether the capacity build earns a return quickly enough to support margins, cash generation, and debt service. PHYZ frames its long-term ambition as 100 billion yen of revenue. The Nearer 1 2027 plan points toward continued expansion, including new warehouse capacity, automation, and sales development beyond Amazon. Structural tailwinds are real. Japan's e-commerce market is growing, and the post-2024 driver constraint makes capable logistics partners more valuable. But revenue is not the whole scorecard. The plan succeeds only if new sites ramp efficiently, cost inflation can be passed through, and the customer mix broadens over time. The peer comparison explains why PHYZ screens as interesting but not effortless. Its roughly 24% return on equity is well above the cited logistics peers, while its 8.8 times forward earnings multiple is lower than their roughly 12.5 to 14.1 times. Investors are discounting the small float, customer concentration, warehouse execution risk, and the credibility of the profit forecast. The valuation gap can persist if operations margins do not recover, so the next reported results matter more than a static multiple. The report's scenario analysis is an illustration rather than a price target. Starting from 1,148 yen, its 3-year bear, base, and bull cases span 886, 1,949, and 3,265 yen. That unusually wide range reflects a small number of influential variables: the cost ratio and utilization at the Yokohama Sugita warehouse, Amazon volumes and terms, wage and fuel inflation, and the ability to diversify customers. The chart is most useful as a reminder that operational execution, not headline sales growth, drives the outcome. PHYZ combines a real operating edge in staffing and integrated e-commerce logistics with strong historical revenue growth and high reported returns. Its valuation looks low on forward earnings, but that cheapness is conditional. The key evidence points are operations margin, the ramp of the Yokohama Sugita site, free cash flow, customer diversification, and management's profit guidance. The upside and the risk come from the same source: its deep relationship with Amazon. Please explore the free deep dive at Uncovered Japan for the full research series. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.